Welcome, everyone, to this Police Pension Board special meeting. And so I guess I'll turn it over to you, Mark.
Yes. Thank you, Mr. Chairman. A few months ago, the Police Pension Board requested that Jamie and I go out to seek RFPs for police pension advisory and management services. So we compiled a RFP, we submitted the RFP. We had 11 responses of new firms, plus the response of our current firm, FMB. Jamie and I narrowed that down to 7 new firms that we interviewed. And then off of that interview, we narrowed that down to 3 new firms plus FMB. So those 4 firms are here today to present themselves to the Police Pension Board. That being said, I'll turn it over to Jamie to start the process. One thing before, for anyone that's speaking, please make sure the green light is on your microphone because the folks online have a hard time hearing if you're not speaking into the microphone.
I just want to start just by saying thank you to all the firms that are here this evening. Appreciate everyone being here and making it to this meeting tonight. First up, we have our incumbent FMB Wealth Management, Mark Renzini, is here to present.
Thank you, Jamie. Thank you, Board. Good evening, everyone.
Good evening.
For those who didn't hear the announcement beforehand, my partner, who's usually here at these meetings with me, Adam, is not with me tonight. He's going to be a dad for the 2nd time, hopefully tomorrow. His wife's going in for a C-section, so I told him to stay home tonight, and I try to carry on without him. So at any rate, we're glad to be here, glad to be part of the process. And, you know, as the incumbent, obviously, you know our team, you know our investment philosophy, you know how we operate. You know, I believe that during our tenure with you over many years, you know, if you look at our process, our service, our performance, you know, that adds to value. And that's really, at the end of the day, what's the value you're getting out of this relationship. So if you look at what we've done over the years, you know, one of the things we've worked to significantly improve the investment policy that we have here with the plan. I mean, working with you folks, especially over the last few years, as the profile of markets and global economics have changed, we've been able to keep current with that. You know, I could point to some things where we've looked at a lot of restrictions that were in the policy from a standpoint of what we could invest in, how we could invest it, to more recent things like looking at the weighting of the S&P 500 and how that's changed over the last several years with AI, new technology, companies like NVIDIA, and modifying some of the restrictions that were in place in terms of how much we can hold of any single stock. Those working with you to make those changes has really paid off for the plan and allowed us that additional flexibility to make moves like that as the market dictates. We've been able to do, through that, do better asset allocation and risk management to achieve your funding and liability profile as it relates to the plan. You normally see Adam and I, but our back office are kind of our unsung heroes. We process over $1 million worth of benefit payments annually for the plan. So timely, accurately. It's very important. And we've continually worked to tailor your portfolio to meet or exceed all of your actuarial assumptions. Over the last several years, we've not only navigated 3 financial market downturns, 2015, 18, and 22. And in between there was a global pandemic as well. So the plan came through that strong and continues to grow. If you look at the result of all of that, so far this year we have a return of over 10%, total return. That's year to date. 1 year over 11, 3 years over 12. And that's the result of continuing to tailor your investment policies and monitoring the market to make sure that, again, as I said, we want to meet or exceed any of the requirements that this plan has, which now has, I didn't look at it as the close of today, but we're getting pretty close to $28 million here. So it's been some nice growth over the last several years. So again, all of that adds up to, why do you do this? What's the value? Well, the depth of our team, the credentialed individuals that work on this plan. As I said, our back office that processes over 500 transactions every year for the plan and over $1 million worth of benefit payments. We act as your backstop as a fiduciary. And I think if you look at the blend of that, the services that we offer, and obviously what the cost is to the plan, that's tremendous value. And we've done that year in and year out. We've appreciated all the years that we've worked with the board on this plan, and we would certainly welcome the opportunity to continue to do that. So with that, if you have any questions for me, I'll be happy to answer them.
Questions from the board? Don, anything? George?
I was just going to say, when you've worked with somebody so long, you ask for questions. They've all been answered over the last number of years, so.
Well, yeah, and there's a lot of board members that, I don't know if you get together beforehand or not, but we do, Adam and I do a lot of these plans together, and you need to be prepared for the questions from this board, usually. So it's one of the comments that we usually make before one of these meetings when we have our pre-meeting call. It's like, it's Springettsbury, Adam, you better be sharp tonight.
I mean, something you said kind of triggered a question, and I'll just throw it out there. Not that there's any right answer to it, but as you look at the investment landscape over the next 5 years, are there any major changes coming that you see? I mean, everybody talks about AI and how that's going to impact the world. AI or anything else you see that we need to start thinking about as a board over the next 5 years, that today's maybe the day to start thinking about those kind of things?
Well, I think, and in our normal course of meeting with you, we've touched on that subject. AI is not hype. AI is not going away. It's going to change the way the world does business. We've talked about the digitization of currencies. That's something else that is not going away. You're starting to see many world governments adopt things like that. Many financial institutions, not only mine, but I'm sure others in the room, are talking about things like that, and stable coins, and how you transact business. So, and there's a financial landscape and an investment landscape to that. So, I think a couple of those themes are are front of mind. We've touched on both of those a little bit. We're going to continue to see a more intense geopolitical environment as well that we need to think of. The world is kind of retooling supply chains and deciding where things will be made, how things will be made. And they will all impact how we recommend that we invest this portfolio. I had an opportunity over the summer to talk to a lot of young bankers in State College, and they asked about AI as well in terms of banking. And the best piece of advice I guess I gave them was, I said, AI is not going to take your job. Someone who knows how to use AI better than you is going to take your job. So learn how to use AI, and we all have to do that. We are currently piloting a version of AI that's within the banking system, so it's not connected to any external servers. And we are using that now, testing it in every aspect of our business. So if we're doing it, then, as I said, the rest of the world is doing it, and there's going to be winners and losers, and we're going to have to sift through that. And that's why our investment process, our research, our staying on top of things, and discussing our best ideas with you every 3 months is critical.
Thank you.
Questions? All right, thank you, Mark.
Thank you, Mark.
Jamie, I'm going to assume that everyone who submitted a proposal submitted references, municipal references to you. Is that correct? Yeah. Okay.
Next up, we have CBiz Investment Advisory Services, LLC. Today we have Rich Ritzer, Peter Riviello, and Jen Cole here.
Hello.
Now we're on. Okay. How's everybody doing?
Good.
Good. What's that? Yeah, might as well. Yeah. So while Pete's handing out the hard copies, I just want to take a minute to express our gratitude. We've been in this business for a long time. We understand the RFP process can be very arduous for you and the township. So we greatly appreciate the opportunity to be here and kind of share our approach. So just want to share that with you. So we greatly appreciate the time and the opportunity. My name's Rich Ritzer. I'm Vice President of CBiz Investment Advisory Services. I'm one of our advisors. I'm also thrilled to be joined here with Pete Riviello, who's also been in the pension business for over 25 years. He's also one of our advisors. And saving the best for last, I've got Jen Cole from our office. Jen's really I like to think of her as the glue that kind of holds everything together. She is our internal person who works with all of our municipal clients, ensures that our pension plans run very smoothly on a day-to-day basis, and really the single point of contact there. So we'll talk about that in a little bit. And then, do I have the clicker? There it is. Yeah. So a little bit about our firm, right? How did we get here? So we started in the early 90s, and this is the business we're in. We found that Pennsylvania is a unique space. There's more pension plans in Pennsylvania than the rest of the country combined. And we found that as an opportunity. And we found that a lot of communities really needed help with their pension plans. They were very underserviced. The fees were very high. There was a lot of ambiguity. So we built a robust kind of a turnkey solution and haven't looked back. And fast forward to today, we were actually acquired by CBiz. We were originally INR Advisors, acquired by CBiz back in 2018. And CBiz as a firm actually manages and oversees over $73 billion in assets. Now, our office, we're located in Delaware County in Media, but we're all over the state. We have clients ranging from Philadelphia all the way to Pittsburgh. So I'm kind of a road warrior. It's kind of bad that I know like which rest stop has which coffee places. I'm at that point now. So, we do take it very personally, and this is the business we're in. You fast forward to today, we have over 130 municipal defined benefit pension plans here in Pennsylvania. Many of them, most of them being police pension plans. So we really know how to articulate the pension valuation. We can speak to Act 600, Act 44. At the end of the day, we take a consultative approach. The investment component is the engine. That's a very important component of the pension plan, but it's not the component of the pension plan. We like to discuss and provide educational opportunities to the committee at every meeting that we have. So it's decisions on how it's going to impact your MMO, your minimum municipal obligation, your funding levels. All those decisions come into play in addition to the underlying investment management. That's what our clients have embraced over the last 30 plus years, is more of that consultative approach. And the beauty of it is we are completely independent. So we do not have any proprietary products. We sign on as the fiduciary advisor, which I'll talk about in a little bit as well. And this is the business we're in. We've over 130 pension plans. We've also have an offshoot of our business where we've developed 457 drop participant-directed plans, 401A. So we kind of know this in and out. Even Jen probably knows pensions better than anybody in the state. And we work with actuaries throughout the state. I know John Vargo very well, who's your actuary. I just talked to him the other day. Jen talks to him all the time. So we know how to kind of put all those pieces together to really look at this thing holistically. But I think what's really neat too is I would put our investment philosophy and approach up against anybody, and we'll get into that. But what I'm most proud of is the service component. That's what I'm most proud of. And that's why I brought Jen here as well. Now, if we had the privilege to work with the township, the money would be held at Charles Schwab. So think of that as like the refrigerator kind of holds the money, holds the pension plan. We're not affiliated with them in any way. And we built this turnkey solution such that it's basically an extension of your staff. And the beauty of that is we're handling everything from soup to nuts, except for the actuarial component, which is handled by Conrad Siegel. So we are handling the pension payments to the retirees. We're handling the tax reporting, the 1099, you name it. That all flows through our office. And what's really nice about that too is not only the township has a single point of contact, but the retirees have a single point of contact. And that's very, very important to us because you guys are putting your lives on the line every day. I mean, look at it, the tragic events that happened here a couple weeks ago, right? I mean, that hits home to us. We've been working. A lot of police officers, we continue to talk to them even after retirement. They just love calling Jen just to talk sometimes. Okay. And we get to hear all the cool things that they're doing. So the beauty of it is they get to call a 610 number. Somebody's going to take care of them, whether that's a retiree trying to change their banking information, their address, their tax withholding, or if it's Jamie or Mark or whomever's handling the contributions, somebody's going out on retirement. We're handling all that from soup to nuts. And we've also included in tab A for the hard copies, these are actual sample reports and documents that we use in our process of folks going out into retirement, refund of contributions, contribution submittals for the pension plan, you name it. So we really do take that approach very seriously. We take it personally. And over the last 10 to 15 years since we've been here, I've not seen us lose a single municipal client. And a lot of that is based on the service that we're able to offer to a lot of our clients. So if I'm not sure if Jamie or Mark or anybody had checked the references, I'm sure they'll tell you that. Most of our clients on average have been with us for probably close to 15 years, some longer than 20 years. And that speaks volumes based on the process. A lot of our clients came to us in a sticky situation with their pension plan, and they're in a much better situation today, which I'll talk about in a little bit. So what's also unique is we do have an entire investment team behind us. So our headquarters is in Cleveland, even though we're in media in Delaware County. We have a chief investment officer, Jennifer Hutchins, and we have a full research team where Pete and I sit on the investment committee calls, which is a weekly call. Sometimes it's more frequent than that if there's a lot of market turbulence, a lot of market volatility. We'll have more than weekly calls. Sometimes it'll be every other day, like we saw earlier this year. So we are backed by an entire research team, and we also work very closely with Vanguard. Vanguard's right in our backyard. You'll see that We use a lot of Vanguard funds, and that's not because we have any affiliation with them. We believe that that's probably the best option that we have available for our clients, which I'll talk about in a minute. So we do have an entire team set up behind us with respect to the decisions that we make in the investment portfolios, and then it's our job to delineate that to the committee and how that impacts your MMO, your actuarial valuation, and so on and so forth. So we can have more of that consultative dialogue throughout the relationship. And originally in the 90s, now I wasn't here in the 90s with CBIZ or INR, the team was doing what's called a managers of managers approach, an active manager approach. So I'm not going to assume what people know or don't know. An active approach is essentially if people will say, hey, how's the market doing? They'll say the S&P 500. That's a proxy typically for the stock market. That's the 500 biggest companies in the US. An active approach would be somebody who's maybe picking 100 out of those 500 to try to beat all of those 500. But the problem with that, cost will increase, and sometimes you're not really going to hit those home runs consistently. A passive approach is saying if we can't beat them, join them. So we're going to invest in all 500 of those companies and mirror the market. That's what we were doing in the 90s. We were having a managers of managers approach. We were constantly firing and hiring managers because they were too expensive, underperforming, weren't beating the benchmark. And in the early 2000s, we realized, well, if we can't beat them, join them. So we transitioned to an all-indexed approach using Vanguard, and you also see some iShares from BlackRock. We haven't looked back, and it's been over 20 years, and it's worked for us, it's worked for our clients. And a lot of that's due to some of the decisions that we've made with our investment committee, and working as a team to construct the most appropriate asset allocation to get the return that John Varga is using in your actuarial valuation. And I'll let Pete speak quickly too as to his experience with indexing.
Yeah, sure. Thanks, Rich. Yes, and so just to kind of add on to the low-cost ETF approach, in my prior role, I worked at an active management firm for over 20 years prior to joining CBIZ. And for years and years and years, we would sit in rooms like this with groups like yourselves and have to defend our fees constantly. Over time, it was something where, even though that was my job, it didn't really align with how I even invested my own money. So I choose to invest my own money in low-cost index funds. And Rich is going to show some of these on the following page. But just to point out that it's becoming increasingly more difficult for active management to beat the index, particularly net of fees. And that's why we believe that this, and you'll hear us say this over and over again, this is the most efficient way to do this. And if there was a more efficient way, we would do it. And that's why we have such conviction in this process.
Yeah, and when we adapted this approach, it has evolved over the years, and it continues to evolve, and in a good way, and that's benefited our impact, or benefited our clients. And I'll teach you real quick what our clients learn. They learned that asset allocation is the most important decision that we're going to make, number one. And that would be the first meeting we would have if we had the privilege to work with you. Based on the actuarial valuation, our job, we're tasked with figuring out as a team what's the most efficient way to achieve a 6.75% rate of return, which is what John Varga is using in your valuation, over the long run. This is a police pension plan. It's going to be around forever, longer than anybody in this room. So that's the approach that we take. I get it, the markets are emotional. Money's emotional, investing's emotional. We take the human emotion out of it completely. And I'll explain that in a second. So we're tasked with understanding what's the most efficient way to hit that 6.75% while reducing cost as much as possible and adapting those low-cost ETFs. So our clients learn, number one, with those lower-cost funds, we're owning everything in the world with those ETFs. We're owning everything. So if you ask our clients what they own in the portfolio, they're going to tell you we own everything. Within our investment philosophy, I like to call it actively passive. So you might hear some folks or competition say, well, they're just going to put you in an index fund, and that's it. That couldn't be further from the truth. We are making tactical decisions where we are overweighting certain funds, we're underweighting certain funds. So that's a very, very important component of this style of investing. So we're going to own everything. We're going to find the most efficient asset allocation based on our long-term return assumptions. And what's probably most important that our clients have benefited from, and this is taking the human emotion out of it, is rebalancing. Anybody remember what happened on April 8th? It was when President Trump came out with the big tariff thing, right? The markets were down 20, 25%. Big tech was down about 25% on that day. Many US stocks were down double digits. And we have the ability, because these ETFs are very, very efficient and liquid, we have a full-time trader on staff. We were able to rebalance our portfolios to take from bonds that actually held their value at a gain and buy these underpriced securities at a 20, 25% discount. Another thing our clients will tell you is that we're gonna look smart at some point, we just can't tell you when. And at that point, we look smart pretty quickly. We were able to buy those stocks at a discount, and within a couple of weeks, the market ran. So we bought those shares at a very significant discount. And a lot of our clients have benefited from that. Believe it or not, our clients benefit more from market volatility than you would believe. Because again, we're taking the emotion out of it. We're using the liquidity in the ETFs to buy low, sell high, right? Everybody says buy low, sell high. Nobody ever does it because it's emotional. We take that out of it. That's where our clients really come into play and really benefit from this. So owning everything, we're gonna look smart at some point, I just can't tell you when. And the asset allocation decision's the most important decision we're gonna make, the weighting of stocks and bonds. And then what I wanna show you here, this is not me saying we're recommending 60% stocks and 40% bonds to you. I would say you're right there within shouting distance of what our projections are of what we would recommend. This would be a decision after our first meeting, again, if we had that privilege. And that's what it would look like. We actually wanted to show you in real life, hey, in real time, if we had the privilege of this pension plan, what would it look like today? Well, this is what the allocation would look like. You know, we're not hiding anything. It's low cost. You'll see a lot of Vanguard, some iShares. We tend to hold some cash in there that's paying a pretty nice rate in the money market. And we hold the cash to pay the retirees. So we have that liquidity to pay those folks. And the weightings are determined by us and our investment committee based on the current market environment. So we just wanted to show you, kind of give you a little bit of a sneak peek of what the actual asset allocation looks like. And when we construct the portfolio, we're really looking at this again from a long-term perspective. So what we've included here is what's called a capital market assumption. Really all that means, it's a fancy word for what do we expect the stock market to do over the long run. And in this case, what we're showing you based on our data, we expect US large companies to average about 7.5, mid-sized companies 8.5, et cetera. And what we do is we put all this together and mix it up and determine, hey, what's realistically an expected return over the long run for a 60% stock and 40% bond portfolio? And how does that coincide with what John's using in your actuarial valuation of 6.75? Well, I'll tell you, we expect to get about 6.65% over the long run in a 60-40 mix. Guys, that's within shouting distance of your 6.75%. A lot of our clients that we brought on board, when we first started working with them, were using a rate as high as 8%. Actually, most of them were at 8%. And that was very unachievable. We were showing them back in the mid-2010s, 2015s, you're gonna need to be all in stocks to get 8%, and that's not even a given. And that's just not prudent risk. So the fact that you are right there, I mean, kudos to you guys and the current firm you're working with to get that down, because there are still a lot of communities out there that continue to want to punt not dropping that interest rate because it makes their MMO payments much lower. So they're kind of kicking the can down the road. So the fact that we're there, we can probably start to de-risk depending on what your current asset allocation is to decide what's going to be most efficient. And why I'm showing you this is a great example of setting expectations. So here's a quick case study. Oh, real quick, it's also important to educate you on risk, right? Because I'm showing you over the long run, I expect 6.65% in the total market. But just understand that over the next year, I could be as low as negative 8.9 and positive and as high as 26.5% over the next 1 year. I'm gonna sound like a weatherman there, right? That's the best I can give you over 1 year. But what do I expect to average? About 6.65%. And then the longer we're looking at this thing, the same way John Varga's looking at this in the valuation, the more accurate we can be. Because the research that goes into these projections is using the entire market, and that's how we're investing our clients' money. And why this is so important, again, setting expectations, this is the exact projection we showed one of our clients of a pension plan that's almost identical size, a police pension plan. We showed them this back in 2015. These were our forward-looking assumptions. Now, they were at 8% in their assumed interest rate. So we told them, listen, guys, you're gonna have to take on a little bit more risk. So we recommended a 70% stock and 30% bond portfolio. And we showed them, you're at 8%, but we're expecting to get 7.68% ballpark on average. So we're gonna have to make some decisions. They're still a client today. Their funding level's at about 100%. Their non-uniform's overfunded. Their police is 95%. Their interest rate's down to 6.75. They were at 8% and their funding level was below, they were around 70 at the time. Why I'm showing you this, we told them 7.68%, and then our previous meeting, we showed them the 10-year trailing. That little box there, the net return was 7.76%. So we were within 2 basis points. Oh, I'm going the wrong way here. I went the wrong way. We were within 2 basis points. Oh, it's the bat button. We were in 2 basis points of what we were projecting. We were showing him 7.68. I'm sorry, we were about 8 basis points higher than what we projected. This is not me saying, look at how great the performance was. It's saying we set the expectations, and as a team, we were able to bring down that interest rate, increase the funding level, and do it together. So that's what we do. And within that time frame, a lot happened from 2014, as Mark just alluded to. With down markets in 2015, 2018, 2022 was one of the worst markets we've seen, especially with bonds, in a long time. And we were able to do that because we took a lot of that emotion out of it and implemented some of those strategic moves that I talked about earlier. So it's about setting expectations. And when we talk about the fee presentation, the fee component, we're going in at 0.2%, so 1/5 of 1%. And the average underlying fee of the fund is about 0.05%. So all in fees are 1/4%. And that includes everything I just alluded to. Pension payments, 1099 forms, meetings. We don't nickel and dime you for payments or AC. Literally, the only fees that you will see with us is that 0.2% that's deducted quarterly. So that 0.05, that's quarterly. And it's transparent. You know, you're seeing that every quarter. We can't get any more transparent to that. So we find that it's very competitive, being at 1/4%, because again, the lower the cost, the lower the hurdle for us to try to attain that 6.75% while employing some of those strategies. And what's very important to us, if we had the privilege to work with you, is the conversion. As a matter of fact, we just took over another pension plan this week, and we're doing it right now. We have the notices going out today to the retirees that, hey, we're making a change. Call us if you have any questions. Jen's working her tail off, scrubbing the 1099s. We get the check registers. We get everything set up in the system. The most important thing is ensuring that there's not a missed pension payment. That's the most important thing to us during the conversion. So we work very closely and very diligently with the township and the incumbent provider to ensure a very smooth transition. And then obviously completing and executing the necessary paperwork to set up the custodial accounts with Charles Schwab. We sign on as the fiduciary investment advisor, which I meant to mention too, in tab B in the hard copy we handed out. We have a pretty neat little certification. It's a third party called Dalbar. They vet all of our processes, our procedures, contracts. They interview our clients to make sure we're doing what we say we're doing as a fiduciary investment advisor. And they provide a certification letter saying in our assessment, and it's pretty rigorous, we do believe that in fact they are acting in that fiduciary capacity, which provides comfort to the township and the trustees. So we did want to include that in there because that's very, very important. So the transition, again, we're helping you through that throughout the entire course. And then the first meeting again would be determining the appropriate asset allocation, so on and so forth, working with the incumbent to get the funds wired over, and then subsequently reallocating the funds to the asset allocation that we decide on as a team. And, you know, there's no trading fees, anything like that. Again, it's just that literally that 0.2% is what you see. It includes literally everything. The only other costs you're paying are whatever you're paying to your auditors and your actuary. So everything else is taken care of within that. So I wanted to be cognizant of your time. I know it's the night before Halloween. It's October 30th, so I didn't want to take too much of your time. So with that, I'll kind of wrap up and open up to any questions that you all have.
How many CFAs do you have managing in the investments?
CFAs on our research team, we have roughly 10 up in Cleveland.
Do you invest in individual stocks? Or is
No.
it, you do not?
Not with our pension plans.
Have you reviewed our pension plan and our pension investment policy?
We've reviewed the investment policy, yes.
Okay.
Yeah, we would, because of our approach, if you were to look at our policy, it's much more broad. We find it to be much more broad than detailed because of our index philosophy. So it creates a little bit more discretion.
So we would have to make changes to our investment policy here at Springettsbury because I think we have a requirement of individual securities and individual positions, which probably would not work with an index investment strategy.
Yeah, we would recommend, if it's explicitly stating that that's the one thing we would change, that we would be open to having individual stocks, but that's not within our strategy.
Okay. All right. Thank you.
Yeah.
Yeah, I think that is defined more that we don't want a fund that has more than a certain percentage of a single stock than it is you have to invest in individual stocks.
Yeah, and you'll see that in some of the index funds that we have. For example, I think the elephant in the room, as Mark alluded to earlier with AI and big tech, has been basically driving the markets the last couple of years. And we've benefited from that because of the Vanguard Growth Fund is primarily led by big tech. And if you do look at the weighting in a 60-40 portfolio, it's well below whatever that weighting is. So that wouldn't really come into play. We'd have to continue to see significant momentum for that to be more than, say, 5% of a single holding in the portfolio in our strategy.
I think that's what you're getting at, isn't it?
I thought our policy does require that we have to have a certain number of individual positions as individual securities as opposed to an index fund. And I was trying to call up the investment policy, and I can't remember that.
I'm not remembering it that way, but that's fine.
Jamie, do you have the investment policy handy?
I don't have it with me right now.
Someone does. Yes, please. Thank you. I'll look through it. You guys can ask other
All right, cool.
questions.
Any other questions?
Any questions from anybody? Don?
I do, but I'll defer to anyone else
Okay,
first.
George. Go ahead.
I have a couple questions, actually. First of all, obviously you hitched your wagon to Vanguard, and I'm familiar with Vanguard.
Yep.
What would cause you to eventually walk away from, how do you evaluate Vanguard's performance or changes within their management structure? What would cause you to maybe change that mix going forward?
Yeah, that's a great question, George. So the biggest thing is liquidity. So the Vanguard ETFs are extremely liquid, and that allows us to make those, on April 8th, we could do $2 billion in trades in the blink of an eye. I mean, we could certainly do that with iShares and some other ETF strategies. Vanguard has consistently driven down cost faster really than anybody. So cost is an important component. So we do evaluate cost. We look at the indices that they're following. They typically use what are called the CRISP indices, which for us we feel is a pretty good representation of blanketing the broad global markets. So for us it'd be the management structure. We're usually on site with Vanguard once or twice a year, so we have a pretty good idea of what that looks like. But primarily it would be if there's an issue with cost, which I can't imagine that. As a matter of fact, Mike, who's not here tonight, our president, sat with Gus Sauter once, probably 15, 20 years ago, about telling Gus Sauter that, hey, ETFs are going to be a race to zero, and Gus said, no way. Well, look at us now. So, the biggest thing is the indices. It's the liquidity of being able to trade when we can, when we want, and the underlying efficiency of the indices. So, and that's why we have one of the iShares in there, the high yield, we felt was the most efficient security for that sector.
And then my second question, somewhat related to that, but you have a page in here, you call it your process, where you list the funds and the allocation. Is there also somewhere in here the performance data, if you backdated those funds for, say, 10 years, what the performance of this allocation would have been over the last, say, 3, 5, 10 years?
I believe we incorporated that in the RFP. We also subscribe to something called GIPS, Global Investment Performance Standards. So what that means is in that portfolio, we have a third party that vets so the performance we provide is true performance. It's not hypothetical. Okay. So there is a third party that we engage with, and it's very rigorous, where they vet and audit our performance data and say, yes, this is under the GIPS standards, under the CFA.
Is that net of fees or gross of fees?
We show both.
Both, okay.
Yeah.
Jamie, I would be interested in seeing that at some point.
And I can follow up and send them again, just separate,
Okay.
tonight.
As you know, or maybe you don't know, we meet quarterly. The pension board meets quarterly. How do you think we could best use our time in those quarterly meetings? What do you think is the most important thing this commission should walk away from each of those meetings knowing or feeling or getting out of those meetings?
Yeah, and that's a really good question. And that's why Typically, the investment conversation, a lot of that is not the primary makeup of the meeting. It's a good chunk of it, reviewing investment performance, what do we anticipate the market's doing. But at the end of the day, here's a great example. At the last meeting, we reviewed the valuation. We're not even the actuary. So we're helping the committee really, truly understand the impact of our decisions on the valuation, on your MMO. And a great example, the takeaway would be, here's one thing we recommended to our clients outside of reviewing investment performance. We expect a lot of market volatility to start picking up. Why not? A lot of people will wait till the end of the year when they get their state aid to put their MMO deposits in. We recommend to our clients, hey guys, we believe there's a lot of market volatility ahead. Why don't we start, if you have the funds, start putting in that MMO throughout the year so we're buying in at different market points so you're not kind of putting it all in at one lump sum. Sometimes that, you could benefit from that, sometimes you don't. But if you're dollar cost averaging in, and that's what that means, dollar cost averaging, you're buying into the markets at different points throughout the year instead of at once. So little things like that, little takeaways. Also, how we could discuss maybe reducing risk because of the last valuation, or hey, what's the impact of our capital market assumptions and if we reduce our interest rates? So it's a little bit more consultative than just, hey, here's the performance. Why don't we talk about this now, but also what's the expectation going into the next valuation?
And then my last question, I know you mentioned you handled a lot of police pensions in the state, and I think I also heard we're at 28 million in this plan. Mm-hmm. Where does that fit us in your scale of client size?
You're smack dab in the middle.
Right in the middle. Okay.
We have one that's a couple 100,000. We have the city of York. We've got ones that are, I think, Upper Darby's about 120 million. Mm-hmm. But right in the middle is between 25 and 30 million. It's like smack dab in the middle.
Okay, thank you. That's all I had.
I think Don may have.
Yeah, I thought he had.
Don?
One question. Who would we expect to see at our meetings from your firm?
It would be myself and Pete. Sometimes Mike may join too, depending on if we're having to kind of divide and conquer. Mike Lacken's our president, who started the firm back in '92, but it would be primarily Pete and myself.
Thank you.
Mm-hmm.
I think that's about it. Thank you very much.
Yeah.
All right,
thank you all so
guys.
much. We really appreciate it. Thank you.
Thank you to Rich, Peter, and Jen.
That it?
Next, we have PNC Institutional Asset Management. Here tonight, we have Michael Ball, Mark Yesenchak, and Hannah Schrift. Welcome.
I still have this. I promise I'm not done.
Thank you.
Thank you.
Thank you.
Thank you.
Push the button. Is it green or red? There you
Green. There we go. Thank you. Good evening. So I thought, first of all, thank you for having us in today. Real pleasure to be here. It was great to be here previously, and glad we can come back. I think we'll start with quick introductions, if that's okay. I'm Mark Yesenchak. I'm a senior relationship strategist with our institutional asset management group. So we'll talk a little bit about what that means here in a minute. I'll talk about the role. What my role is really to get together with our investment advisors and make sure that we are really delivering the best services, most customized service that we can for our clients. So I have a background the past 23 years working with municipal pension plans. I've been with PNC for about 6 years now. The 17 prior to that with a competitor firm. So I hope what you'll see today is really the same reason that I came over to PNC. I think the tools in our toolbox, especially for pension plans, are far exceeded my expectations when I came over. Really, again, I worked in Pennsylvania most of my life. Really seeing a lot of the benefit that we can bring to our clients through our solutions for pensions.
Yeah, thanks. My name is Michael Ball. I am a senior investment advisor with the Institutional Asset Management Group. I'm based in our Lancaster office. I specialize with pensions, endowments, foundations, working on the investment side, also working with analytics to try to work on asset liability management, spending plans, and so forth. I started in this business in Ronald Reagan's second term, so it's been a while. And the past 25 years, I've been here with PNC. There is a bit of deja vu here for me. I did manage this plan from 1997 till about 2001 when I was with Mellon Trust. So I don't recall the place being like this, so I think there's been a bit of a nice upgrade since that time.
Good evening, all. My name is Hannah Schrift, and I'm an investment advisor within our institutional asset management division. Within my role, I work exclusively with institutional clients who are very similar to Springettsbury Township Police Pension, and I partner with Mike on a variety of relationships within the central PA market. Thank you so much for the opportunity to present tonight, and we're looking forward to the discussion.
So let me start out first, just kind of setting the tone here for what we plan to accomplish, really a summary of benefits. We hope to get through most of this here tonight, but really I want to show you what it's like to be a client with PNC, and also show you what makes us unique and really how that will benefit the township and the pension plan and its participants. If nothing else, I would say the takeaway for us and really how we like to think of ourselves versus our competitors is a smaller niche firm with large-scale resources of a large financial services firm like PNC, and we'll show you a lot tonight about what that looks like. Start off a little bit about that institutional asset management group I mentioned. So as the name might imply, we only work with institutional clients. A lot of the times we hear folks think of a bank as someone working with a lot of individual clients. We do have a private wealth division. We work independent of that group, only with institutions. So that's really where we focus. Of that, one of our largest segments is public pension plans. In addition, we work with corporations as well as nonprofits. A couple things come to mind when I think about our institutional asset management business. So one, all of our solutions are both comprehensive and custom, so there's nothing sort of off the shelf that we do. We'll talk about our research team in a minute and all the work that we do there to create these individual portfolios, but also with our pension solutions group. We have a pension solutions group with a number of actuaries involved who help provide us a lot of background. We don't look to replace your actuary, but provide us with a lot of the background that we need to work with our clients. And then lastly, high-touch client service is important to us. We do a number of surveys with our clients as well. We're very proud of the service that we provide. Our average client tenure is 26 years with the Institutional Asset Management Group. So again, very proud of that. We manage about $48 billion in assets under management. About $15 billion of that is retirement assets. Drill down a little bit further, 87 municipal pension plans we work with in the state, and our performance has been strong. I know you asked in the RFP about performance. We provided some like plans, some other municipal pension plans. In your folder, there is an update on those performance numbers through both 6/30, and we were able to get 9/30 together as well, too. So thought that might be helpful for you as you look to compare firms. I think last thing I'll mention is some of those clients that we have here in Pennsylvania. I know staff reached out to Swatera Township. That's one of our longer-standing clients. So I'm sure you learned a bit from them. I'll also mention on the other end, the one we have here, City of Wilkes-Barre, is one of our most recent transitions earlier in the year. That was a somewhat complex transition too. So I think the point here is any of our clients would welcome you to speak to them to get an understanding of both what we've performed and how we've done over the long term, but even things like how did the transition go? Why did you select PNC? We'd welcome you to reach out to them. Go ahead, you can say. I'm just going to pause and see if there's any questions at this point on IAM is PNC IAM is an overall firm. If not, we can maybe dive a little bit deeper into the investments.
Just one quick question. You did mention you have a number of municipal plans. Same question I had to ask the last group. Where do we fit in your profile at 28 million?
Yeah, I don't have an exact average. I can tell you our overall institutional client business is just under about 20 million average client. I think the clients that we gave you, the 3 representative clients we gave you performance on, were all right around that, sort of 20 to 25 million range. We tried to be as representative as possible of what it might look like for your plan.
Okay, thank you.
Yeah, sure. So if you could just slip it ahead there. Deep resources and experienced teams is really an understated strength of ours. As you can see there, with over $200 billion in assets under management, a team of 170 plus that are working on multiple asset classes in the research team and strategy teams. All of this represents an opportunity for Springettsbury Township, and that is with this type of scale, we attract the top managers. Managers want to work with us, and so they come to us with their best offers, the best pricing to give us the opportunity to put them in their portfolios. But we run an open architecture process that does not require us to utilize any proprietary managers. So PNC has excellent managers, but if they're not going to fit into the strategies that we want to employ, we're under no pressure to put them in there. On the open architecture process, we really go forward with the idea that nobody has a monopoly on the best ideas. So we want to be open to whoever can provide the best strategy to execute and put that into your portfolio. Our strategies are are all internal. Our team does all of its own research. We do not rely on the likes of Morningstar or Lipper. We do utilize some of that analytics, but we don't. We do our own proprietary research, which is important because our analysts go out and ask the questions as they pertain to our particular strategies. So we're assured that we're going to be able to get the managers in place that are going to execute properly on all of the strategies that we want to employ in our portfolios. And having all these resources has provided our clients with consistent top performance over the years, which is why we have such long-term relationships. One of the things that is important once we get all of this work together is to apply that into the investment policy statement. I'm going to turn it over to Hannah here to go over the IPS.
So as an investment advisor, one of our key responsibilities before beginning any new relationship is a thorough review of your investment policy statement. And as you all know, it's really a way to document governance, oversight, investment management, and overall monitoring and evaluation of the pension plan. So on pages 6 and 7 of the deck are really the key sections that we look for when we are reviewing an investment policy statement for new clients. As I mentioned, Mike and I did review your investment policy statement and would like to compliment the investment committee because, as you can see by the check marks listed on pages 6 and 7, you all included many of the best practice sections that we look for and recommend incorporating. One recommendation that we would have is a review and update of possible benchmarking. So just to give one example, within your current policy statement, you all are using the S&P 500 to measure your U.S. equity portion of your portfolio. We would recommend having a benchmark that reflects your current investment strategy. So the recommendation typically for pensions is to include not only large cap exposure, but mid cap and small cap exposure as well. So we'd want a benchmark that reflects exactly that. So something like the Russell 3000 that incorporates large, mid, and small would be a recommendation that we have for your policy statement. It's important to review your benchmarks because ultimately that's a way for how you all are able to measure our success. So in summary, Mike and I will work with you to revisit your investment policy statement, provide recommendations for efficiencies and improved governance for all of you serving in a fiduciary capacity. I'll pause there and see if there are any questions as it relates to the investment policy statement before we dive into how exactly that fits into our investment process for pensions. Okay, hearing none, I'm going to flip ahead to page 8. So shown here in the top is our investment process that is unique for pensions. It's a disciplined, repeatable process, but also incorporates flexibility so that we can incorporate your unique goals and objectives. And this is where that policy statement really comes into play and is a starting point and the crucial starting point within this process. If we shift to the right, looking at the green and the asset liability study, what we hear from a lot of our newer clients is that they've never had an asset liability study completed. And a differentiator of this modeling in our minds is it doesn't just take into the relationship your assets, but that liability component as well. And we think that's really the unique component of this process. It allows us to integrate your plan's unique financials so that we can ultimately provide a clear, customized path so that you all can meet not only your performance, but funded status goals as well. And using this study really helps us illustrate how different strategies are going to impact future pension outcomes. And I think it's important to note that this is not a one-time modeling exercise that happens at the very beginning of the relationship. Just last week, during one of our quarterly reviews with our one of our pension clients, we suggested an update in this asset liability study to ensure that their current asset allocation that we have still fits and still makes sense for their goals and objectives. Overall, this framework listed here provides the investment committee with a transparent, evidence-based tool to make sure that you all are making effective investment decisions, ultimately enhancing your fiduciary oversight and governance. And so, that's a lot in words. I'd love to turn it to Mike to show you an asset liability study and really show you how this comes to life for our clients.
Yeah, thanks, Anna. So again, the bullet point there on the left side of that page there talks about how our process looks to project a range of future outcomes for you, which are going to focus on funding status and contribution levels, which is utmost importance we find to municipal pension clients. This helps us in understanding risk, because it's not just market risk we're looking at, it's also looking at the liabilities and looking at the risks that you're going to take on for funding and budgeting. So that, we think, is also something that we want to pull into this, because when our main goal here is to drive that cost lower, at the same time lowering the risk of the overall portfolio. Inside of your package is an asset liability sample study. I'm not going to go through all of that with you. I just want to draw your attention to a couple of pages in here that my clients have found to be really key in determining how best to approach changes not only to the investment policy, but also to things like the rate of return on assets that's going to be your discounting mechanism here. So on plan sensitivities,
Just real quick, Mike, this is on the left-hand side of your folder. I'm going to make people dizzy here, so close your eyes if you want to, as I get to that page here for those on the screen.
So as Mark moves through there, you're going to see and hear there. So plan sensitivities, two things on here that are important for us. One is there's always a question of what happens if the markets go up or down 20%. We can't predict when that's going to happen, but we need to anticipate that these things do happen. So what are the outcomes are going to be when these do occur? When we look at that, which helps to look at how we're positioned in the portfolio and what actions we would be able to take to address that. The other part of it is what happens if you want to change your actuarial rate of return on assets there. So typically that's a discussion that's driven with the actuary, but we have actuaries on our team that are really focused on the investment side of things, and they work with us on helping to project what that impact is going to look like. So if along the way you want to make a choice, should we make a change in that? We're always prepared to come to you and give you that information and show that to you as on an ongoing basis. The other part of it there is just a few more pages ahead on page 10 there. Here we're going to always look at the long-term projected funding that we expect. And this becomes the glide path that we want to work towards. This is a snapshot in time, projected out 10 years, just as the actuarial report is a snapshot in time of just one period. It sits stale for a year or two, depending on when it gets redone to help you with that MMO calculation. But we put that in motion. Every quarter, we're going to come to you. We're going to measure and map where those actuarial value of assets has moved, where the accrued liability has moved. And we're going to come to you with a very comprehensive package that really helps clients to make sure that we are delivering on what we say we're going to do. So it really gives, in my experience, has given my clients a high degree of confidence in the decisions that they're making, because they can see the impacts on a live basis as opposed to making assumptions based on stale data. So this is all on the front end of the portfolio that goes into everything. We're going to look at the investment policy. We're going to do this study for you. All of this is going to come together for us to put together a portfolio that meets with the characteristics that are born out of this study. And so when we look at what that portfolio might look like, we'll go back into the main body of the presentation, page number 9, and you'll see a sample portfolio here. So again, here, the takeaways that are important are there's an extended diversification, obviously, going between international and domestic, large, mid, small cap. On the fixed income side, core and high yield, ways to mitigate the overall impacts of interest rates as a means to drive the total return in the portfolio. And, we do utilize a lot of different types of vehicles in there. We're not as concerned much with the type of vehicle that they're in. It's really just trying to identify with who has the best strategy in place. How about passive and how about active? How do we blend those together? Again, our deep bench in research helps us to make that decision. What times are best to use passive and what times are best to shift that to active. So the key from this research is that, is our proprietary research provides a lot of confidence in how that portfolio is constructed.
And I would just make a note on active versus passive. We find that there's room for both types of vehicles within a well-diversified portfolio. We look at the areas in the market of when to use, one or the other. So we tend to use passive investment vehicles in the more efficient areas of the market. Think U.S. large cap, where it's really hard to beat the S&P 500 benchmark, and tend to spend our active management dollars in the less efficient areas of the market where we think it really makes sense to pay up to have boots on the ground. Think fixed income market as one example.
I'll just quickly touch on fees too, since I know that's important. So this portfolio that we've shown here, underlying investment manager expense of that is 14 basis points. So that is a combination of passive and active, but a fairly good fee or expense based on that use of both active and passive management. We think there's a lot of value to be added there. Our fee is 25 basis points. We don't charge with custody. Custody would be provided through PNC Bank as well as benefit payments.
So there should be a packet in the right-hand side of your folder that's quite thick. So if you turn to page 14, within that deck is a sample of a quarterly report that you all would receive. It includes the standard information like a capital markets review and portfolio allocation and performance, but I hope every investment manager is providing that for you all. So rather, I'd like to spend our time on the differentiated reporting that you'll see at PNC if you were to become a client. And again, that first page is on, the first page is on 14. And this is an attribution report. And really the goal of this report is to show you how we are adding value relative to the benchmark. And if you think of attribution, there's really two sources that it can come from. What we call asset allocation effect. So did you overweight the right asset class that outperformed? Think US large cap. And then the second source of value add tends to be from manager selection effect. So did you overweight the right securities that happen to outperform during a specific time period? When you think about attribution or value add, those are really synonymous in nature. Those are really the two sources. And so looking at this report, there's a ton of numbers on here, but anything to the left that shows a negative number is where a decision would have detracted, and anything to the right that's showing a positive value would be where we've added value. The next sample report I want to point out is on page 15. And this is peer benchmarking. And my clients tend to like to review this sort of report on an annual basis. We mentioned that we reviewed your investment policy statement, but we also reviewed your latest meeting minutes. And we noticed there was a question that someone asked about how you all stack up versus like-sized peers in the Commonwealth. And this report shows you and answers that exact question. And so we'll use this report to compare your actual portfolio performance to like-sized peers within the public defined benefit space. And the goal of this report is to have your portfolio performance at least at that median line or above. And so this is just another differentiated report that our clients like to see.
And finally, I'll just point out, as I mentioned in the asset liability management study, it's not static. Pages 26 and 27 will point out to you the update that we bring to you on a quarterly basis, so you can see what's put in motion as we look at your plan status on over a quarterly basis.
I think one key on our reporting is it's highly customizable too. So we do have clients who want to get well down in the weeds on investments and characteristics when they have individual securities and the like. Others just want to know how they're doing big picture. So some of those attribution pages, versus characteristics pages, it's all available. It's really what's going to work best for your committee.
So I think the final things we want to end on are in the main deck on page 10. And the benefit of being with PNC is that you have large-scale resources, and one of the benefits that comes along with that is this significant investment that we make in technology. And one of the ways that this comes to life for our clients is through iHub, our online secure portal. So you all don't have to wait for formal reporting to become available at month end or quarter end for Mike and I. Instead, you can access the portfolio at any point in time on demand through the secure portal. It also offers a way for you all to securely message your single point of contact on the administration side, your institutional trust officer. And I think one thing that my clients like and benefit from is that we don't just hand them a user guide or a handout when they join and say, go figure out the system. We provide one-on-one trading with a real human to provide those demonstrations of the different capabilities. And that happens not only at the beginning of the relationship, but at any point during the relationship or anytime someone new joins on your side of the house. On page 11, we have benefit processing that's integrated within iHub, so that just simplifies the navigation and some of the administrative burden. And then on page 12, from the participant side, we have Payee Web, which provides convenient self-management so they can update things like their addresses or direct deposit settings. And there's readily available help for participants as well within this service. And so it's just one more resource to make your staff's lives easier. And so with that, I think I'll turn it to Mark to close us out here as I see we're bumping up against time.
Yeah, thanks. I think the last thing is transition. And so important to know, just like we have research teams and economic teams and other things that help our investment advisors, we also have a dedicated transition team. We stay on the calls with those. We tend to set up weekly calls, especially when benefit payments are involved, to help shepherd that along and make sure everything stays on track so we can hit our timeline from an investment standpoint. Again, that open architecture platform, we can bring over current investments and work with a portfolio from there. We can, take in cash if the prior manager is to liquidate those assets as well too. Either way works for us. We're flexible. Again, we'll stay with you throughout that process and really do the bulk of the work. So I'll wrap up our prepared comments there again and just come back to where I started with. I think one of the benefits of working with our institutional asset management group at PNC is, again, leveraging those large resources, whether it be the research team, whether it be onboarding, whether it be our online portals, technology, all the things you're going to get from a large financial services firm. But we're going to deliver that locally with a high-touch client service model here with our team based in central Pennsylvania. So again, thank you for the opportunity, and we'll end our remarks and take any questions.
Questions from the team? Go ahead, George.
Tell us about your client retention rate, where that stands.
Good.
Yeah, I can tell you that's a metric that Hannah and I, who would be your single points of contact in this relationship. So if there's, it could be a lot of people on there, but names to remember. But it's always just one name and one number. It is a metric that we are benched against. So we look at we keep about a 98% retention, and that's been consistent for us.
Okay. And then the only other question I have. I want to make sure I understand, because I don't quite fully understand. I'm pretty sure you're trying to tell me it's a value add, this asset liability study that you do. It sounds like a value add that's unique to you from other firms we would look at. And my takeaway, it sounds like you're trying to look at factors that maybe measure cash flow in and out of the plan. Is that correct?
That is that is some of what we look at there.
Yeah, I think the biggest way to summarize that for a public pension plan, different if this was a corporation, a pension plan, somebody might be terminating a pension plan. You're not, right? So our goal is really to keep it, somewhat of a smooth ride. So as we look at these factors to say, well, you were, I think, roughly 96% funded that we saw. So we, definitely don't want to drop down, but we also don't want to go to 120% and lose state aid and other things. So our goal is to keep that ride as smooth as possible and have a bit of a glide path. So our Pension Solutions Group team will come in and work with us to say, okay, what's the allocation look like today, cash flows and other factors? And then what kind of glide path might we put this on to either dial down or dial up risk as some of these different metrics affect your funded status? And as Mike said, we provide that reporting, which gives you a nice in-between look of that as well when you're only getting that from the actuary on every 2-year basis. So we're able to provide that quarterly. It's kind of our view of it. Again, we're not providing actuarial services, but we do have actuaries who can help provide that interim view of it as well. So it just helps us keep it on a little smoother ride.
Okay, thank you.
Don, anything? All right, thank you very much.
Thank you. Appreciate it.
Thank you, Michael, Mark, and Hannah.
Thank you. Thank you.
Thank you.
Sure. Yeah, thank you. Our final presentation tonight is with the Haverford Trust Company. Here this evening, we have David Wittlischbach and Keith Aliardi. Good, thank you.
We're green.
All right. Well, thank you, everyone. It's a pleasure to be here, and we really appreciate the opportunity to come speak to you guys a little bit about Haverford Trust, who we are, what we bring to the table, and what differentiates us. So my name is David Wittlischbach. I'm a portfolio manager at Haverford Trust. I've been in the financial services industry for about 10 years, and I'm joined by Keith Aliardi here, who's our president. Figured it'd be helpful just to set the table before we get into our discussion. So, we'll talk a little bit about the firm itself, our investment philosophy, our approach to the actual investment selection process, as well as, some of the value-add services that we can provide to you as your partner throughout this journey. And I'll kick it over to Keith here to talk a little bit about the firm.
Thanks, David. So, good evening, everyone. As David said, I'm Keith Aliardi. I'm president of Haverford Trust. I'm here for two reasons. The first is to share a little bit about our organization and how we work with pension plans like you. And number two, to share with you how important you'd be as part of a relationship with Haverford Trust. I don't envy you at all. These are four really great firms. I commend Jamie and Mark for their due diligence and vetting these great companies, and we're proud to be a part of the presentations this evening. So you've heard a lot about investments. You've heard a lot about actuarial assumptions and the like. We're going to try to save you a lot of time and just cover what's really different about Haverford Trust. If you don't know us, we've been around 40 years. We're a little over $16 billion in assets under management. We are not the largest organization out there, nor are we the smallest. I think we're the right size for a pension like yours. We're privately owned, and I think that's a differentiator across the competitive landscape. And the reason being is we focus on two numbers within our organization, within the management team. That is client retention and employee retention. And if we know that if we can focus on those two numbers, which range somewhere around 97, 98%, we know everything else falls in place. If you have a consistent relationship management team and one that gets to really, really know you, we also know that our clients stay around for a very long time. And if we can execute on those two things, well, we know we have success and we know our clients have success as well. So as a private organization, we can afford to focus on those two metrics. We don't have shareholders that we have to worry about. We don't have quarterly conference calls or quarterly earnings calls. We can take the long term with all of our clients, and that's one of the things that our clients really, really appreciate from us. From that point, we have over 300 institutional clients and 154 members on our team right now. We're based in Radnor, PA, right outside of Philadelphia, and we really see our opportunity here to work with organizations like you. As I said, one of the things that I think is really different is every relationship we have, it's about a partnership beyond investments. And what that means is, again, every one of the organizations you're talking to this even has a really, really great investment offer. We wouldn't be here if that wasn't the case. But to us, and what our clients tell us, and is that the partnership that we establish with the organizations, the plans that we work with, is critical to their success. And it really comes down to our three pillars of how we work with pension plans. The first is our five-star service. So again, being the size that we are, we really believe we can execute on the service element of how we work with your relationship. Examples of that are, we've been known to hand deliver pension checks when something went wrong. Somebody forgot to change their address. Somebody forgot, something was lost in the mail. When a committee or a board needs special reporting, we'll turn that around very quickly. It's that type of five-star service that we think is really critical. The partnership also is in our investment office, and David's going to talk a little bit more about that. But our roots, our heritage is in quality, what we call quality investing. It's a combination of individual stock and bond management, along with other products to complement our core offering. So we believe that that's a real, true advantage to our clients because we can control the risk and return profile of each and every one of our relationships, basically providing a very customized solution. And third, and maybe most important, is within our values. Our values of integrity, quality, and community. What we have found is that really builds trust with our clients. And without that, we really don't have anything. So that value proposition that we share with each one of our clients, we think is a critical component of how we operate and how we work with our organizations. So I'll turn it over to David.
Yep. So, here you've got our team from the institutional advisory perspective. It's myself, it's Keith, it's one of our partners, Rosemary Dorita, who I'll talk about this in a little bit, runs our institutional advisory services, which, helps with the education piece that I partner with her on. And then you have Kesley Bury, who, helps with the day-to-day custodial administration and retirement plan piece of the team as well. And so, this team is incredibly experienced in working with pension plans and institutions such as yourself. I'm very familiar with the York area. We've been coming out here for years working with the Hanover Police Pension Plan, the Hanover Hospital, St. Martin's Library, St. Matthew's Lutheran Church, just to name a few. But, what we do on a day-to-day basis does not get accomplished without the three boxes on the bottom of this page. And to dive into that a little bit more, I'll flip to the next page here to talk about some of our core solutions. This is our business, and this is what we do. From an investment advisory perspective, retirement plan administration, education and support, institutional advisory services, and then supported by our private banking team. And I can confidently say, in my prior life, about 10 years ago, I worked for Macy's, and I managed $3 billion in their pension plan. And I understand how important some of these analyses and facts and figures some of the folks have talked about tonight, and I've lived that. And so I understand what it's like sitting in your seat and having that information at your fingertips to really give you, the full rounded toolkit to be the best fiduciary you can be. And so we'll flip to the next page here. And so, Keith mentioned this earlier, as a firm, we have quality in our DNA. And what does that really mean? And so that really boils down to, in 1979, we were started, and the quality investment strategy was born. And to me, that really includes two different pieces. First, the quality side. And what quality means to us is investing in healthy companies with balance sheets with minimal debt. Second, investing in companies that have a moat around themselves and are industry leaders. And then third, companies that will come out and give guidance for their earnings and continuously meet that, grow it, and beat it for expectations. And so that's the first piece of it. And the second side is paying a dividend. And I want to draw your attention to the top left here for our philosophy and our three goals. Preserve your capital, growing your portfolio, and managing risk over the long term. And I'm not sure if that sounds familiar, but under your investment objectives within your IPS, that's almost verbatim spelled out. And so, when we take a look at this for pension plans such as yourself, why does this make sense for you? Well, it's a unique philosophy, and a lot of the goals that I've lined out up here up in the top check marks, whether it's higher predictability, lower volatility, hedge to inflation, performance through market cycles, looking at things on a long-term basis for a pension plan like yours that will be into perpetuity. All extreme benefits that align our investment goals to your investment goals. And when you think about why this makes sense from a more predictability, transparency perspective, lower volatility, when you look at the asset value of your assets and compare it to the market value of your assets, such as back in 2023 in the valuation report, you see a dip, right? From I think it was a 12% return in 21 and 22 down to about negative 15 and 23. The investment strategy that we use and employ, and really is the backbone of the way that we look at investments, aims to shorten that gap, shrink that gap by looking at the standard deviation and finding that sweet spot between the risk and return, which we think is entirely critical for pension plans. And so, this all gets born somewhere. And to us, the way that Keith mentioned, we view our values. That doesn't just look outward to you as a client through partnerships. That's the way we view this internally as well. And so you've got a full deep bench of folks all in-house with us at Haverford. And to expound on the story you told a little bit earlier, Keith, with delivering benefit payments, we like to say that's a sweet spot of ours, and I'll tell a little bit more about that story. It's about 8 or 9 years ago. I was with a pension plan for an institution where we were the investment manager, but not the custodian. And the custodian, their systems went down on the 30th of a month. When the benefit payments were going to go out, we got a call from the client asking us if we could help. It was 4 o'clock that day. We went and printed out all the checks and then went and hand delivered them to all the benefit payment, or all the, pensioners, to make sure that they were paid on time. And that to me is a real testament of the team-based philosophy that we really imply here at Haverford. And I'll turn it over to Keith to talk a little bit more about the actual investment selection process.
Great, thank you. So, just, I don't know if I can go back here, but just a quick comment on this as well. Another hallmark of our organization is we are all in one location. So 150 employees, all in one building in Radnor, PA. This team that you're taking a look at, our manager selection team, global allocation team, equity team, and fixed income team, we're all together. So client relationship management, research, all together, working together, and all the synergies that you would expect to that. So it's not uncommon that that in meetings, our research team is part of this relationship group. Our chief investment officer will join meetings, fixed income director join meetings. So we think that that's really important. We get a lot of information, a lot of insights, all because we're all in one location. So really, how this all is delivered to you is through our strategy development. So, and we put a tremendous amount of emphasis on defining your objectives. Our 5-star service allows us to really, really and deeply understand what you're trying to accomplish, what your pensioners are looking for, the experience they're looking for, the investment needs that you as a committee and a board are looking at. And we distill that down to some long-term strategic allocation objectives. You've heard that already. We've included our capital markets assumptions in our appendix. But what's most importantly is that that is the driving force to help you reach your long-term objectives of this plan. Would we do a lot around codifying the investment policy statement? And then, of course, monitor, adjust, and then provide that feedback. We did have an opportunity to review the investment policy statement, and as you've heard, the core components of the investment policy statement are very strong. There are areas that we had some recommendations or would in the future provide some recommendations for you. We've highlighted a couple of the considerations, but I really think the rationales are what's critical here. When there is, we recommend having an annual review clause, having that articulated in your investment policy statement. That ensures that your policy statement remains current, and the committee is versed in that. Define roles and responsibilities. There's a little bit of that. It holds all parties accountable. We would act as a fiduciary, so why not add that fiduciary language into your investment policy statement? Some return horizon questions came through that. It would refine your strategic guide path. And then some asset allocation detail that enhances the communication, the directives to the manager, and then align benchmarks to the allocation. I think there's some things that are just kind of a little askew in terms of your allocation relative to benchmarks, et cetera. You heard a little bit of that, but what it really does is standardize that performance evaluation. Our belief is the more work we can do within your investment policy statement, collaborate with you on that statement, not only are you going to have a better directive, but it also allows us to really and more understand what your goals and objectives are as you work through the economic environment.
Bless you.
Bless you. So from there, once we've established that, we do believe as well in an asset allocation approach. What differentiates us is the fact that we have this strategic tilt towards quality and dividends. And where that comes out is specifically in the individual stock and bond management that we incorporate into portfolios. So David shared with you why we believe in that. But again, it does smooth out long-term the investment portfolio. We think it allows it to be more predictable, and as a result, reduces your obligations over the long term. Yeah, as a committee, you really have two mandates, one explicit and one implicit. The explicit is your actuarial assumption, right? So 6.5%, over the long term, you need to hit that or work as you've done to bring it down, but also relative performance too. And our asset allocation approach through equities, fixed income, and diversifying assets, we think we cover both of those explicit and implicit mandates, and it creates a better opportunity for success as a board. As I mentioned, the core component of what we do is individual equities and fixed income. We complement that core component with passive ETFs, factor investing, active management, all to create a more customized solution. We do have clients, we do have plans that are all index. We do have plans that are all individual security management. That's really where the customization comes in. I think your policy said about individual securities that up to 50%, no more than 50% in individual securities. We think that's a really good blend and gives you a really great opportunity to create the glide path, to create the experience, to create the expectations, and meet your assumptions by being flexible between that combination of individual securities and passive and active managers. From there, it's really about risk management. And again, everything we do embedded in the philosophy itself is a component of risk management. All of this is a goal-based framework, and we weigh the benefits, the cost of each and every security that we put in a portfolio, And obviously, ultimately, it's to optimize the risk and return profile of the plan.
Perfect. And so, as we think about the three core tenets that Keith mentioned earlier, I think, our value-add services really, sum those up and bring them together really well. We at Haverford believe the partnership, to Keith's point, goes beyond investments. And really, what does that mean? It's providing educational resources and events and opportunities for you to learn. We host many events throughout the year, based on the markets, what's going on from a pension perspective, new tax legislation, things that you need to keep in mind as board members and as fiduciaries to do the right thing on behalf of the pensioners. And so, the other part of that is resources. Just last week, I put this up here. I put together a governance and fiduciary responsibilities, best practices, a roadmap of best practices for another client of ours that's just like you, to help educate the board on what are some of the best practices that we see in the space from other clients, such as yourself, that you can take home and bring back to the board as actionable items to help the board move forward. And so, throughout the year, this is at an absolute bare minimum what you're going to get from us. You'll have my personal cell phone number, or my work number, excuse me. You'll have, the quarterly meetings. I like to be here in person. I would love to be here with you on a quarterly basis. And as a testament to the partnership, this doesn't stop at what is on the page, right? That we are constantly trying to innovate, bring new ideas to the table, and bring relevant topics for discussion to our clients so that we can get the most, or you can get the most out of working with us. And so, when we think about summarizing this and bringing this all together, we at Haverford think, our approach to partnership through our 5-star service is a real differentiator. And, being that trusted partner through every step of the journey, whether it's delivering benefit pension payments to, people's houses, or, I'd offer them the opportunity to bring our wealth planning team. We've done this before for another municipal pension plan, where I've sat in a conference room and, we've allowed different pensioners to come into the room, talk a little bit about, what's going on in their life from tax situation, how to best use the benefit payments to help benefit them in their lives, or different ways that they think about their investment portfolio when they're in retirement. So other opportunities like that really enhance the 5-star service that we like to bring to the table. Secondarily, it's the custom solutions. To Keith's point, there really is no one-size-fits-all here, and it's finding the right solution for you that may be very unique from someone else. And so, and third, it really relates back to our quality values. Whether we view that in partnership with you, internally with our team, or the way that we operate on a day-to-day basis. So I appreciate the opportunity, and I'd like to open it for any questions if you have any.
Questions?
Did I miss your fee structure?
It's in the appendix here, but it's 30 basis points.
30? Okay. And the only other question I had is, how realistic is our 6.5 target?
Based on your funding rate and where we view on a go-forward basis, if we look at our capital markets assumptions, let's see. Put them in the back here.
I think we just passed it. It's realistic. I think right now you're about 57.5% equities. I think that's a little short.
Okay.
And I think you'd need to, and this is the challenge is by increasing that weight, the more risk you're taking.
Of course.
And again, what we believe is you assume less risk by the individual component of the portfolio.
Okay. Thank you.
Don? Good. Okay, George.
Don't think I heard you say how many municipal police pension plans you oversee. Did I miss that number?
Yeah, I think we have
two.
Yeah.
Two?
Two.
And where do we fit in that average? At 28 million, are we number 1, 2?
Towards the high end,
The high end, okay.
but not far off.
Okay. I don't have anything else. I'm good, thank you.
All right, anything else, guys? Thank you very much.
Thank you, yeah,
Appreciate it.
appreciate it.
So, do we have anybody in the public? There's one attendee. I don't think we have anybody else from the public here, so if anybody online would like to make a comment on this process, please click the raise hand button in Zoom to be heard. All right, I guess that's about it for this evening.
If I could,
Meeting's adjourned. Thank you.